This is the Ask Faleskini podcast, where the modern economy is discussed from a skeptic's perspective. Mr. Faleskini helps you distinguish what is sustainable in our economy and what isn't. Not everything that glitters is gold, and not all mud is dirty. The podcaster Mr. Faleskini provides no-nonsense advice. He had it all, lost it all, went bankrupt multiple times, and is now attempting to come back from zero with sustainable growth. There are numerous coaches and preachers on the internet that preach about positive thinking and how life is all roses if you just care to see it that way. Well, Mr. Faleskini is definitely not one of them. We recommend you ask Faleskini to keep it real. He discusses the darker side of the current economic reality, the side that's more important for your personal and business finance. His first intention is to help you keep what you already have. Not to be a complete party pooper, Mr. Faleskini will also hint at the earning opportunities in the economy today. In order to please the almighty algorithm, please like, share, and subscribe. And now it's time to start taking notes. The mic goes to the podcaster, the one and only Mr. Faleskini.
Welcome to the Ask Faleskini podcast with a guest. I'm proud to present Amir Goren from Irvine, California. Amir is a fund manager of the Economic Defense Fund and an expert in macro, long, and short-term investment. Amir, please tell us more about yourself. What is your story?
Thank you. I transitioned from technology management into economics, got my PhD in economics here at UC Irvine, and then started this fund. And for people who don't know what a hedge fund is, the idea or the role of a hedge fund is to generate returns even when the market crash. So that's kind of the role. So you are expected to be short, basically, the market or net short when market crash, and that's where the knowledge of macroeconomics and markets in general, financial markets, is crucial.
You have adapted or even improved, and now it's basically your economic theory about how the market works, because the existing economic theories kind of do not work as we were used to. Can you elaborate a bit more about your market theory and its implication to economy?
Yes. The thing that kind of became obvious actually this year is that the stock prices kept going up and up despite interest rates being increased. And that contradicts most economic theories. And so I started to think, and I'm sure others have started to think, what could be an explanation for this continuous rise in stock prices despite the higher interest rates. And basically, if you want to understand the existing theories, there is the classical theory, which says that when the interest rate rises, it incentivizes consumers to save more, and therefore it decreases consumption, and as a result, the economy shrinks. So that's a first theory that didn't really happen this time. The second theory is by Bernanke and others, and that's called the financial accelerator. And according to this theory, when you raise the rates, you basically reduce the profitability of companies. And because of that, the prices of the stock fall, because of lower valuations, and then begins a vicious cycle of a downward spiral of lower profits, defaults on loans, and so on and so forth. And finally, in finance, it is widely accepted that when the interest rates on bonds are high enough, and it's considered to be risk-free, especially government bonds, then what would happen is that the money would flow from stocks, which are risky, to government bonds that are considered more secure. And as the rates go up, they offer a much safer return on your investment. So all of these didn't happen in 2023. Stocks kept rising and rising, and I had to ask myself, what is the explanation for that? And so one of the simplest way to understand the financial accelerator is that it kind of accelerates the entry into a recession, because if today, for example, stock prices would have been 20 or 30% below what they are, it would probably be a little bit recessionary, right? It would scare people from consuming. Maybe companies would start firing employees and so on. So because that didn't happen, I proposed my financial decelerator theory. And that works, that's a mechanism that works through the option market. And it turns out that when the interest rate rises, it affects the price of call options and put options, and basically makes call options more expensive and put options cheaper, basically reduces their value. And so it incentivizes people to buy call options. As long as they expect higher and higher rates, it incentivizes them to buy call options and to sell put options. Now, when you buy a call option while selling a put options, this is called a synthetic, and basically is very similar in the return profile to just buying a stock. And so on the other side of this trade, there are option dealers that have to hedge themselves because they make money only on the spreads. And when people buy call options and sell put options, the dealers are basically buying the put options and selling the call options. So they're basically exposed to the short side, and they have to hedge themselves by buying stocks. And so this mechanism causes stock prices to rise as long as there is an expectation for higher and higher rates. And so based on this theory, I came up with some predictions that we can talk about.
I would thank you for this explanation. I would like your take on the acceleration theory and why it failed. Is it possible that it failed also because it didn't consider the fiscal part of the equation, where US government is spending more and more? And somehow this money also comes down to consumers and to investments. And is it possible that the theory did not prove itself to be correct because it failed to consider all the fiscal stimulus that US government is putting in the system?
That's definitely possible. In the original model, there isn't actually a fiscal side at all. So the original model doesn't include fiscal policy. It only has monetary policy. So it's absolutely possible that that was a contributor. But I don't think that it's correct to say that it didn't work, because in 2022, the stock market fell fairly significantly.
Mm-hmm.
So once it was clear, once the Federal Reserve made it clear that we should expect higher interest rates in the future, the stock market immediately started to use that interest rate into its calculation of the valuations, and stock market fell very sharply during the first half of 2022. But then what happened is that the actual rate started to increase. So I would say the accelerator worked while it was only an expectation for the higher rates, but then it stopped working when the rates actually started to go up in reality.
Mhm.
And my explanation to that is the financial decelerator. So once the rate started to go up, and there was clear expectation for another step and another step and another step, then the financial decelerator kind of neutralized the fall of the stock prices due to the accelerator. And so one of the prediction, a good theory has to have to generate predictions that are testable, to show if it really works or not. So the first prediction that is testable is that the theory says that if the rate hikes stop, then the accelerator would kick in again because the decelerator would stop working, and then the accelerator would be free to operate. And so what I said is that if indeed the Fed stops hiking, we should see the stock prices fall despite the good news of no more hikes. And that kind of happened on Wednesday, when they basically said that they don't see much more rate increases. And despite this good news, the stock market fell both on Wednesday and today. It's too early to declare a win, but it's so far so good for the first prediction, at least from the initial response of the market.
Okay, so that is the first confirmation that your theory is an upgrade to existing theory. Yeah. What I would like you, or I would like to challenge you now, to help the average entrepreneur that is more in microeconomics of cash flow, profit and loss, and expenses, how we could translate this, let's say, macroeconomic theory into more hands-on microeconomic. What could the average business person take of that? Is there any way, because you explained in the beginning of hedge fund that is basically hedging about or securing investments against what is going on in the market, let's say negative effects of the market. Is there any hedge that is possible on the microeconomic level of everyday life of entrepreneurs and business people in US?
Yeah, I think the first thing that I can offer is the second prediction. And the second prediction is that the decelerator also works in the other direction. So if the Fed at some point starts decreasing rates gradually, then you would expect that to be good news, right? You would expect that this would be kind of a help to the economy. But the financial decelerator actually predicts that it would push the stock market even lower because of the options, because of the effect on the options. So it's too early to kind of rely on that too hard, but if it's correct, then you should take that into consideration and not expect that once rates start gradually decreasing that everything is good and the storm is over and we're in the clear. That's the first thing. The second thing I would say is that we could be facing some challenging times for two reasons. One is that we are in a restrictive monetary policy right now. And the second is we have some structural deficits in the energy market. So we have neglected the oil and gas sector for a couple of decades. And as a result of that, there is a shortage in oil and gas supply. And the US government dumped a very large quantity of oil into the market over the last year. And that helped to reduce the oil prices that spiked after the beginning of the Ukraine war. but it was only a temporary fix. Now that the US government stopped releasing oil, the price jumped again. And so we have a situation where we have economic tightening from two directions, both the interest rate and the oil price, and that puts a lot of constraints on consumers. So I think that business people should be defensive. So the best way that I could say to hedge is to be defensive, to cut costs, to be very careful with the spending, and to preserve every bit of cash flow. And in terms of tailoring services or products, I would tend more toward promoting services that are cost saving, anything that is more affordable, more essential, and to go less for the very high-techy, glamorous things that we've been seeing over the last 10 years. And I think there is less room for those at the moment, and more room for productivity enhancing products, for cost saving products and services, and so forth.
Okay. Two questions that just popped up for me. One is in US, it's really popular to invest your profits in real estate. Do you think that people should continue doing that, or they should just wait for about 6 months to see how things will progress with interest rates and all this?
So I think that the real estate in the last couple of years has been very frothy and got to very high prices. And what happened was that part of that was the Airbnb boom. During the pandemic, many people moved to places or moved from one place to the other, working remotely. And many people invested in Airbnb apartments. And many of those apartments are standing empty. And so there is a big shadow inventory in the US market that is not in the market right now, but some of these apartments went back into the market to be sold, and they weren't able to sell them. So now they're on the rental market. And in any case, I personally believe that the real estate market is in a bubble again. And this bubble will be one of the bubbles that will deflate in this coming year or two. So obviously the higher rates cause high mortgage rates, so that completely stopped any transactions of retail sales, other than builders who are still selling. But what they do is they have some kind of a trick. Instead of reducing the price of the home, what they do is they give you help with the mortgage, as if it was, let's say, 1% instead of the 8%. And so they are kind of reducing the price without reducing the price. So you don't see actual price decreases in the market, but in reality, there is actually some discount that is going into these sales. And so all I can say is I had some properties that I sold last year in preparation for this.
Okay, great insight. I have another question that pops my mind always. With all these bubbles that you mentioned, one of them is property, and another one important is that stock price is overpriced, so that they might be also in a bubble. Is it possible that high inflation would deflate this bubble? Is that something that can happen?
I don't think that high inflation by itself would deflate the bubble. I think it will reinflate the bubble on the other side, probably even more vigorously. But one of the problems that the Fed will have is that we have structural forces that are causing the inflation. It's not just, I mean, they may have spiked it with too much fiscal stimulus and sending checks to people and so on, but this is not the only reason. There are a few reasons. One reason is that after COVID, companies saw that they should have some supply chain that is more perhaps closer to home, and even if it costs a little more. So there's a lot of deglobalization that is happening right now. So that's one force. After the cost reductions of outsourcing everything to China, it became clear that there are some downsides to this. The second thing is that there is some tension between, in the geopolitical space, between the powers like the US, China, Russia. And so that also incentivizes companies to bring some manufacturing back home or closer to home and so forth. So that's one structural development that is causing the inflation. The second structural development we already mentioned, which is the oil market, and that causes a lot of inflation. It hurts consumers through gas prices, electricity prices, heating prices. So that's another structural problem that will take many years to solve. I mean, even the left wings of the politics in the world that were supporting the renewable energy understand now that it's a little bit unreliable, and now nuclear is becoming the new option for clean energy. But it takes years to put in some nuclear electricity capacity in place. So this will take some time to resolve. And there's another force that is operating, and that is the population. So we have a decline in the labor force age population, and we have a bigger cohort of baby boomers or older people who are retiring. And so we have a smaller cohort of working people supporting a bigger cohort overall of consumers. And that creates some tension between the bigger demand or the demand cohort, which is the overall population, and the supply cohort, which is the labor force population. And that's, I think, we have some hopes regarding artificial intelligence. Maybe that could kick in and could help with this particular problem by making the labor force more productive. So all the prophecy, the doom prophecies about AI may not come to pass, and maybe it could be a force for good after all in reducing inflation.
Would you agree with one of the claims of Milton Friedman was that inflation is just a direct consequence of full employment? So if there would be higher than 10% unemployment, then the inflation would start settling. Would you agree with that?
Yes, but that would be temporary, right? So this would be, so I think, inflation could have come down if there is a recession and unemployment, kicks in. But then on the other side of it, it would come back. And that would make it tricky for the Fed, because I think they will have to be careful not to reduce the interest rate to zero again and start the whole process again from the beginning. So they will have to worry about the unemployment, but also they would have to worry about the comeback of the inflation once employment goes back up again. And so there is another force that is happening because of the geopolitical tensions, and that is the probably the decline of the use of the US dollar as the global reserve currency. And that's another concern, I think, for the Fed, because what might happen as countries adopt bilateral transactions, instead of using the dollar as the medium of exchange, they just exchange their own currencies back and forth. Then what might happen is that the demand for dollars from the global trade would decline, and that would cause the US dollar, and I'm talking about the long term after, right now it's on a bullish trajectory, but over, the next 10, 20 years, I expect the US dollar's role in global trade to decline, and that would reduce its value relative to other currencies. And
Can I
currency
propose a contrarian opinion?
Okay.
I don't believe that US dollar is in decline. I do believe that it might not be as many transactions, but as a mean of exchange, it will take a long time that the things will stop be calculated in, or at least calculated into dollar in order to make a comparison to their local currencies. I don't see this. It's very popular opinion in US that US dollar is in decline. I don't see it as such, and I don't see this as a critical macroeconomic factor. Because, for example, there is a Swiss franc that is also in decline and is currently fixed to euro, and it did nothing bad for the Swiss economy. Before US dollar was dominated was Swiss pound and pound sterling, so our currency in UK, and we still use it, and it's still useful. So I don't think this domination of dollar is so important as it is presented. I do believe that it's often excuse for the structural problem that you have addressed before, like population. And also, if I understood correctly, inflation will not solve the bubbles, but increased productivity with artificial intelligence might solve the problem with the lack of workforce that we're all facing it. And it's same also in Asia, even with the growing population, that the actual workforce is just getting smaller and smaller by the day. So improved productivity could do something. Could we speculate that, for example, average business person, should they use more devices? Should they try to use AI assisted ads to help them improve their profitability and stay in business? What's your take on that?
I think it has to be a very simple calculation of how long it would take you to return the investment, right? So presumably these are not free. But if you can return the investment within, let's say, 6 to 8 months, then it's probably worthwhile pursuing. So if you have an app or some kind of virtual assistant or any other productivity tool that can reduce costs somehow, or allow you to offer a new service that saves costs for others, then that would be a good move, I think.
Would you claim or dare to say that in the 80s everyone proposed that everything will be done by robots, especially in the car industry. I know that you have first-hand experiences in the car industry, and robotization took much longer than anticipated, because in the 80s was like this. In the 90s, everything will be done by robots, and there's gonna be no need for human in the factory. They will just bring iron there, and there's gonna be cars just shipped directly to to shops from the with robots, and no people intervention and anything. But we know that 40 years later, we're still seeing a lot of workforce in car industry. Do you think that artificial intelligence might be the same?
Well, it depends on what, there are many types of artificial intelligence, as you know. So some of them are much less complicated to implement than robots. If it's an app on a computer or a virtual assistant, as long as you're talking about software mostly, it's much easier to iterate on, much easier to improve. So I expect artificial intelligence to increase productivity much quicker than robots. And I think that, when people talk about robots, it's really, I think the understanding has to start from a business goal. So the thinking has to be, what are you trying to accomplish with a robot? And just saying we want to replace, there has to be a clear business case and a clear reason or a hypothesis of how the robot is going to change the process of production. Like you always say, it's about redesigning the process, right? So I think Tesla really used robotics in a smart way by redesigning the process instead of just patching on top of an existing process and making, just adding a robot to put instead of a person. That usually doesn't work. So usually you would want to rethink the process. If you want to design robots, what exactly are you trying to achieve by that? And to design the whole production line, your whole production process, your whole provisioning process with this new technology, whether it's robots or AI and so forth. And then you can see what is the gap between where you are today and what your vision is for the future, and design a path of how you transition gradually from where you are to where you want to be. I think that's a more holistic way to address it.
Okay, thank you for all these insights. I have one more question I cannot withstand not to ask you while we are in the interview. And that is, as a conservative treasurer, I always recommended everyone not to use leverage. However, you're a hedge fund manager, and I'm sure you can hedge against higher interest rates or variable interest rates. What would you recommend to an average business person in US? Should they use leverage? Should they continue to use leverage? How could they protect themselves against interest rate? What is the best hedge to go for this uncertainty? What's your take on that?
So first of all, the interest rate is so high that leverage doesn't make any sense at this point. That's why real estate investing is also not economical at this point, because the interest that you would pay on the loan is so high. So leverage absolutely doesn't make any sense at this point. I obtain leverage by using options, not by using loans or margin and so on. And I think that there are ways to protect yourselves. I think that you should choose for the most, let's say, conservative approaches. So I can't, make any recommendations, but when I sold my real estate, I put some of my money into short-term government bonds to just give me some safe interest rate until I see what is going to happen in the next year or two. But I wouldn't, short treasuries or all the, there are many large hedge funds that are doing all sorts of interest rates plays, like shorting long-term bonds and buying with that money, shorting long-term bonds and buying shorter-term bonds with higher interest rates. That's not for most people, including myself. I think there's some risk to that. So.
Thank you for all these beautiful insights. Where would be the best place to reach you if some of our audience would like to start following you and get in contact with you?
So you can look me up at economicdefensefund.com. That's my fund. And I also have a Substack newsletter. Mm-hmm. It's called ecomdef.substack.com. And that's mostly where you can find me.
Okay, I will include links in the description. Thank you, Amir, for being my guest tonight. And I hope that listeners have had a lot of useful info from macroeconomics into microeconomics.
Okay, thank you very much for having me.
Thank you, Mr. Faleskini, for this outstanding podcast. And thank you for listening to the Ask Faleskini podcast until the end. Mr. Faleskini would love to hear your feedback in the comments. And don't forget, if you want to know, ask Faleskini or listen to the Ask Faleskini podcast. In order to please the almighty algorithm, please don't forget to like, share, and subscribe.